Welcome everyone to the Catalyst Funding May 2023 Real Estate Market Update. And this month, we are pleased to be back with all the latest updates on the real estate market, especially the major Texas metros that you're waiting to hear all the data from. And we have a special guest this month that we always love to have. We have Steve Davis from Total Wealth Academy. Steve, we love partnering with you. As a lot of people know, we've got a big event coming up here in a few weeks in the Dallas market. So for all of those that are in the Dallas area, we're going to be at Bar Louie near the Toyota Music Factory in the Irving Las Colinas area. If you're a real estate investor and you're looking to assemble the team that's going to make you successful, this is the place you need to be on Wednesday, June 7th from 6 to 9 in the Dallas area. Let us know, let your loan officer know, or feel free to contact us if you want some more information on that. Obviously, if you look on social media for Catalyst Funding or Total Wealth Academy, you're going to see it all over that because we want you to be there. With that being said, I want to turn it over to our founder and CEO, Wade Comeaux, and the Director of Lending, Jeff Johnson, to give a more detailed history of our relationship with Steve Davis and Total Wealth Academy, and we'll dive into the real estate market update.
Sure. Yeah. We always love working with Steve. We partner with him and his team on so many different things. And I really love the impact that they make in people's lives. I like Steve's approach that it's not just about real estate. He talks about so many other things. I'm a regular listener of his podcast. It's on Spotify and other channels. And they just make a big impact in people's lives, not only changing their financial future and creating generational wealth through real estate investment, but also in their personal lives, relationships. His approach is outstanding. And I can't say enough great things about their group. If you don't know about it, check it out. If you've been thinking about joining, we highly encourage it. And I hope you get a lot of great info from him today, as I'm sure I am. Anything else to add to that, Jeff?
Yeah, no, I say I do like your podcast a lot. And when we hire new loan officers, honestly, we do training, but we also say, hey, you need to immerse yourself in the real estate investment world and the lingo. And yours is the first one that I always recommend, to be honest, because you talk through the entire process from start to finish a lot, which is great for people that are just getting into the business, even if, even our employees. So glad to have you here to talk to us today.
Good to be here. Thanks a lot, guys.
So Steve, tell us a little bit about what's going on with Total Wealth. Any big things going on? Any exciting developments?
Yeah, the single family has been pretty flat. The number of deals that we're doing has been pretty consistent, but the commercial side of it has kind of blown up. We're picking up apartment complexes, literally 6 million below market. One lady bought for 15 million a property that appraised for 23 million the day she closed. Sellers are aware of the higher interest rates. They're aware of the higher insurance, so they're dropping the prices. In the major metro areas, what we're seeing, like Dallas, Fort Worth, Houston, they're not dropping that fast. They're dropping, but not as fast as, say, Uvalde, all the other smaller cities. So yeah, that's what's been going on, is just a lot of commercial acquisitions.
Yeah, I think there's going to continue to be people under a lot of duress in that space, right? You have bridge loans that are coming up. Maybe it's a balloon note that's coming due, and the world in which their net operating income was calculated whenever rates were 4%, insurance and taxes were lower, it's very different than that world today. So I do think there's going to continue to be great opportunities in that space, as long as I know sellers have been a little bit unwilling, I've heard, to sell until more recently, but there eventually comes a point where if you got a balloon or you got an adjustable, you can't kick the can down the road anymore, right, Steve?
Yeah, they're just harming themselves. The longer they wait, the worse it may get. It could get better. I just don't see that in the next year or two.
Yeah, agreed. Rates just aren't going to be able to come down that much to make that big of a difference. All right. Well, let's go over the disclaimer very quickly, Derek, and then we can dive into the meat of the presentation.
Sounds good. I'll offer the disclaimer. As always, one lucky winner does win half off their next hard money processing fee. So at the end of today's presentation, one person who's live and listening will be a part of our drawing to win that. So with that being said, let me bring the typical disclaimer, which is all this great information, all this great knowledge that we're bringing today from our industry experts, that this presentation is for general information only. Anything that's said by our guest speakers, our representative, our experts here, none of that, if it's used to influence your decisions on real estate investing, we're not held liable. We just want to give you great knowledge, great information to inspire you, but we don't have any liability in that. So with that being said, I'll turn it over to Wade, Jeff, and Steve for this month's real estate market update.
Thank you, Derek. We can go to the next slide. I'm going to very briefly tell people a few things that we do that we think make us different. We are a one-stop shop for both hard money and permanent financing. We are experts in the single family 1 to 4 space, but we also work in that small multifamily space. A lot of those good deals are in that small multifamily space, so be sure to reach out to us if you are interested in that category, because we're very good in that space on both bridge financing to purchase and repair, as well as long-term financing. We have a 5-star average customer service rating on all social media outlets, including Facebook and Google. And we have a very unique model in that we have that single point of contact model, one credit pull, one loan officer. You can get this wide variety of products. And we're also real estate lenders built by real estate investors. Many of our team are real estate investors. I also own a single family portfolio of my own. Many of our team does as well. So we try to take that information to help you succeed and avoid some of the mistakes that candidly we've made over the years. And we try to really integrate all that together to give you great customer service. But let's go ahead and dive right in. We are based in Houston. Steve is also based in Houston. So the first slide we're going to cover is Houston. We have built this report a little bit differently than you may have seen it in the past for some of our listeners, and then also for Steve. We really want to focus on a couple things, and I'll let Steve cover what he sees in Houston. But we've got April 2019 here, right? So that's kind of a pre-COVID type era there. Then we got April 2022. April 2023, and we're trying to compare all those things. I think one important thing to think about in real estate is you can get a misunderstanding if you're comparing to what was arguably the hottest market in history in April 2022. So we're trying to bring context. Pre-COVID, which was kind of like a balanced market, the hottest market in history, and then where we are today, bring context to everything. And Steve, with that in mind, tell us what you're seeing out there in this data, and also anecdotally in your dealings in single family.
Well, the prices have obviously continued to rise, as almost right along with the inflation, the crazy inflation. We're seeing our rents going up as well, not as much as in the past, but still continuing to rise. But we've had to reposition our rental properties into the 250 to 400 range, where before we were like $200,000 to $300,000 was our target model. So that has increased. The number of distressed properties, I think, has stayed about the same. I haven't seen a dramatic increase or decrease in the number of deals that the members are doing. That's why I mentioned earlier it was kind of flat. The flips, we're doing our flips between 300 and 500,000. Not going above 500, because if something happens, they really don't cash flow once you get above that. But I really think that there is still opportunity if you're out there hustling. The only people I see getting the deals are the hustlers. The people that are doing this is just kind of a sideline. They're getting 1 or 2 deals here and there. And one of my students did 9 deals last year because she's a hustler.
Yeah, that's a great point. And, you can see here year over year, median sales price and average sales price, they're down slightly. If you're looking at pre-COVID, up 30%, which is a huge number, obviously 35 and 35. But what we are seeing right now is, while some investors are, you call them hustlers, I also call them like savvy people who are still confident in what some people consider a scary environment. One thing we are seeing is like the discount before rates went down was like a 10% discount. The average person on a Our rental deal was paying about 90% of after repairs value, of course, less repairs. Now, on average, in our portfolio, we're seeing 72.5. So that's a very attractive equity capture. Cash flow is actually lower because rates are so much higher, but you're not married to that interest rate, but you are always married to your purchase price, right?
Right.
What you originally purchased the home for. So we are seeing very, very good deals. I think I mentioned in the past that also does line up with the auction.com data that we've seen recently nationally, that discount is pretty consistent on off market or distressed deals. So I do think that there are a lot of opportunities, and I don't know, once rates go back up and cash flows once rates go back down, I'm sorry, and cash flows are increasing, even though, the prices aren't changed. I do think that number is going to trickle back up. I don't think you're going to be able to get deals at 72.5. So for savvy hustlers, I do think there's a real opportunity to get great deals at the moment.
Yeah,
I couldn't agree more. This is the time to hustle. This is the time to really make a lot of money. If you go back to 2008, 9, and 10, I was totally out of single family, just doing apartments. The deals were so good that I went back and bought 20 or 30 of them just because I couldn't resist, and they were on every street corner. So that could occur again.
Yep. All right.
Yeah. So Dallas is actually, if you look at year over year, it's actually significantly better than, say, Houston. I was looking at just as a year over year number, Houston was down about 1%. Dallas is up 3% still. So compared to the other states and the other cities in Houston and Texas, it's doing a lot better as a group. I also look at the months of inventory, 2.1. That's a really low number, lower than Houston, lower than San Antonio. Dallas is very robust, and one of the charts that we get to down the road talks about how many people are moving to Dallas. Like, it is gaining more traction than any other city in the state, I think in the country. So Dallas is a very happening place right now. So that's why all of the other markets are down a little bit, and that one's still maintaining or slightly above. Maybe look at pre-COVID, it's even more pronounced, right? 55% from April 19 to April 23. But Dallas is hopping. Like, they are not seeing the same degradation as the other markets, in my opinion, by a lot. You guys are moving up to Dallas, right, Steve? Is that correct?
Yeah. Did you ask if our members were doing good in Dallas? Is that what you said?
Just your organization is doing stuff in Dallas, right?
Yeah, we're opening up our second office at the end of this year or January of next year. We hope to be open by November, and then we'll do our grand opening in January. And yeah, we're excited because we have a lot of members in Dallas already, and they keep sending back good reports. I'm not seeing the 72%, Wade, but they are 85, 80%, and they're still getting a couple $100 a month cash flow, even with the normal interest rates, because the interest rates are not high, they're normal. But like you said, you're not married to that interest rate. When it drops 2 points, refi, that cash flow is going to go up to $400 a month. So yeah, and like you said, there's so many people moving to Dallas. That's what's keeping that inventory so low.
Yeah, I do want to clarify one thing with that 72.5 is that is all of our portfolio. We are lending in some of the tertiary markets. So
Gotcha.
just like you were mentioning on the multifamily deals, the better deals are out, tertiary, and better is a relative term, of course. You might not have the long-term appreciation opportunity or the stability, but you can get more discounted deals and maybe with better cash flows. And we're seeing that 72.5 bakes in some Beaumonts or, some Corpus Christi's or some other areas that are not the big four, but still are damn good markets, honestly. And I think attractive opportunities.
Yeah, anywhere you can pick up that type of equity is worth it.
Yeah. And the last thing I'll say about Dallas is that appreciation number is stellar, and it's been crushing the other major metros in Texas and really across the country. But it is difficult whenever you see those average numbers. It's a good bit higher than Houston and San Antonio, and you have to go a little farther out in order to get good cash flowing deals, because you just run into those difficulties when homes are more expensive. Like Austin is the greatest example of that. Dallas is kind of the next greatest example. It gets tough to cash flow on single family. That's a reality of it. San Antonio and Houston are much better, but if you go in the tertiary markets outside of Dallas, we're still seeing people get some pretty darn good deals.
That's the same thing in Austin. You can't, it's very difficult, I shouldn't say you can't, to buy something in Austin that's going to have positive cash flow. But in the surrounding, I call them bedroom communities, where families are driving and commuting into Austin, there's still some good cash flowing equity pickup deals.
Yep, for sure. Speaking of San Antonio, that's the next slide here. And you can see that median sales price, 38.7, a little higher than Houston. That's the pre-COVID pickup in property values. Not nearly as big as Dallas, but still a very strong number. The days on market, looking down here, the difference from pre-COVID to now is about 8 days. So obviously it's far slower than it was in April, and this is going to be the same in every major metro. But we're just wanting to bring some context that April 2019 was more of a stabilized market, and the days on market are longer today. Rates are higher, but it's not as extreme as you would think. And I think the big reason why is it's just not as much inventory. Like it's still a market where you don't have an outrageous amount of inventory. There's less inventory than there was in April of 2019, which you might think is surprising because rates are higher and there's not as much demand. But there's also not as many deals on the market because people are reluctant, if they don't have duress, to give up their 3% or their 4% rate on their primary, right? So we're just not seeing as much inventory out there to be a big drag on prices in Texas. Anything that I know you guys do a little bit of work in San Antonio. What's the word on the street from your group about San Antonio, Steve?
Well, it's funny you mentioned Corpus Christi. I would have to say that of the last deals that I've mentored on from San Antonio members, they were all Corpus Christi deals.
Huh.
Which is humorous to me because I think San Antonio is a fantastic place to invest, but the people in San Antonio are literally buying property in Corpus. And one deal, this lady bought it, rehabbed it, and walked away with $12,000. So there's some tremendous opportunities in South Texas that people are taking advantage of. If we go back and say, well, what's going on in San Antonio? I don't have a good barometer for that because they're, my top dogs are investing outside of San Antonio.
That's very interesting. We do have some people that are definitely doing some deals there. A lot of our business is coming out of San Antonio at the moment, but and the deals are kind of they're not quite that 72.5 on every deal. Like you said, that's often the tertiary markets are driving that down, but we're seeing really good deals of good equity capture and solid cash flow. Cash flows are not what they were when rates were much lower. We're not seeing a bunch of 500s, that's for sure. I think investors have to be more reasonable. If you're getting a few $100s of cash flow in the current environment and you're getting a very good purchase price, ROI is what drives the game. And the ROIs are very strong because the out-of-pockets are significantly lower than they were back in whenever rates were much lower, for sure.
Yeah, I just want to bring up everyone, they see the negative numbers and people get nervous. Always focus on the months of inventory. If that number is in the 3s, like it is in San Antonio, it's in the 2s in Dallas, it's in the 2s in Houston, it's in the 3s in Austin, that's still a very strong market, and you're not anywhere near the not a collapse, but the significant downturn that you saw way back 10, 15 years ago. That's 3 months of inventory is a good, strong, solid market. It's lower than it was 4 years ago, and nobody was talking about any negativity in April of 19.
Yeah. One thing my members in San Antonio have said is that leasing has shortened, where they were, taking 10 to 14 days to lease a single family. It's now almost instant. They're,
Yeah.
the third day they've got somebody filling out an application and they've got them closed by the fifth day.
That makes sense. We have a chart at the end of this presentation that would probably give a lot of insight into why that is. But that makes total sense to me.
Yep, for sure. Next slide being Austin. And, Austin is a very, very interesting market, arguably the hottest market in the country this time last year. Definitely not the hottest market in the country at the moment, but still the numbers are interesting, right? If you look for the numbers pre-COVID, still up 45% from that time. That's greater than San Antonio, greater than Houston, not as big as Dallas, but year over year, down 15%. That would be painful if you happen to buy at that particular moment, for sure. That's real pain there, without question. This is not a market where we see a lot of buy and hold investors really doing deals. We do see flips out in that area, and I think there's a lot of people that were doing flips. If you were doing a flip, to Steve's point earlier, and you were doing in those high price points and you lose 15%, that could be very, very painful. So one thing to always keep in mind, and we're aligned with Steve on this, is that we think if you're going to be a flip investor in the current market, and we still work with a lot of people who are, they're savvy, they're making sure they're getting good deals. It's great to have a deal where you can have a second exit strategy. If it's a deal that you can cash flow on a DSCR loan or on a conventional loan, or potentially find a way to get into an Airbnb type transaction, it just gives you options, because you don't know exactly where things are going to happen. If you're doing a $1.5 million deal or a $1 million deal, you don't have many options. You're not going to cash flow on that deal if the market happens to get more problematic. So we're aligned with Steve that sweet spot for doing flips is 500-ish and below. And if you can get a good solid flip at 350 where you know you can cash flow, then you're in a much better and safer position.
Yeah, we just, as a lending organization, when anybody comes to us and says they want to flip a property, we do everything we can to talk to them and convince them that's great. If you want to flip a property, we're all there for it. But you should get approved, hopefully with a conventional approval if you qualify. Even if you're a regular guy with a regular W-2 job and flipping is on the side, or maybe you have tax returns that could support a conventional approval, get the conventional approval, because you never know when you're going to be in a situation where maybe the numbers have turned on you a little bit and you don't want to flip the property. It makes more sense to hold on to it, even if you're cash flowing little to nothing. If you look at these numbers over a long enough timeline, you hold on to that property 5-10 years down the road, that thing is going to be worth way more than it is right now. But if you don't get the conventional approval, you're really limited. You either got to flip it or hope that you can qualify for a DSCR loan. And a DSCR loan, if you don't qualify, you can do the deal, but the LTVs are reduced significantly where you got to come out of pocket a little bit.
One other thing I just want to talk about the stats is correlation, right? Like if you look at Austin, you see that their home values are down the most of the markets, but also the days on market are some of the longest. 71, that's a 21-day increase over that normalized pre-COVID market. When you look in the other cities, the prices aren't down as much, and also the days of market aren't as impacted, right? You've got San Antonio only up 8 days from pre-COVID, Dallas up 9 days from pre-COVID, Houston only up 5 days. All these things play in to, it's a supply and demand metric. So whenever you're thinking about markets to invest in, always keep that in mind. And the national numbers are not as attractive as Texas. That's what we're going to start to segue into, is talking about understanding real estate investing and how it's very different by geography. The national numbers are going to be different than numbers in pockets. And that's both within states and especially and even within cities. So we're going to start to talk about a couple of reasons why we feel like Texas is a bit of a unique story eventually, but we're also going to talk about some other trends in multifamily and single family as we move into this next slide. So I'm going to cover this and then get, I know Steve and his group do a lot of multifamily stuff. So I thought that this number was pretty amazing. Multifamily construction reached a new historical high of 941,000 units, up 17.2% year over year. Single family units under construction slipped by 2.3. So whenever I think about this, one thing I think is that we're in a market where you don't know if you're going to be able to sell properties as easily because you have to have people that are willing to pay higher interest rates, and they may continue to trickle up. Conversely, everybody's got to live somewhere, right? Like you might choose to rent if you can't buy, but everybody has to live somewhere. Population is growing. And I think this is a big factor here because multifamily construction is really booming at a time whenever it might seem counterintuitive because rates are going up, but single family is not going up as much. It's not as dipped as much as some might think, but it's still going down. That's my take on it. Steve, I don't know if you have any other insight as to why multifamily might be going up so much while single family is coming down.
I think it's the increase in population because those permits wouldn't go out if the cities didn't see something that we are unable to see. They know that people are moving in, they're coming, more are going to come. So that's got to be the right reason that the cities are allowing that many units to be permitted to be built. That's an amazing number. I had no idea it was that high.
Crazy.
The one that confuses me is the single family. I know in my brain, I'd be building the least expensive I could. I'd be building every lot I could, but I'd be building the lower end entry homes because there's so many people moving here that want those and need those because of the higher interest rates. That's what I'd be focused on. I'd be up right now. So that's really odd to me, unless the expenses of building a house right now are just so doggone high that you can't build.
I think that's it. I think that's it. I was going to mention that. I was like, I know I talked to some builders. This is a while ago, but the cost to build a new property was so high. The economics are just difficult to build a property and price it at a price point that makes sense. What you're talking about, the lower end price points to have people buy them. It's too expensive to build a property, is what I understand.
Yeah, we purchased some siding. The price was at least 175% or 200%, probably 200% of what it was a few years ago.
A couple things to keep in mind with that too. I think that is a national number. The new single family is not down in most of the major metros in Texas because net migration to Texas is really high right now. I think that's also baking in. You got some markets where home prices are really down. The entire Western U.S., especially California, prices are really down. It's also a heavily regulated state. I've seen that there are more building permits in both Houston and Dallas in the entire states of California at the moment. The entire state of California. So that's a profound number. That's been ongoing. So this is very geographic, and we're going to kind of deep dive that geography a little bit more as we go into some later slides. But this next slide is really interesting too. Days on market. So I've had a lot of people, whenever we're talking at networking events, being very nervous about days on market. I thought this is really, Derek did a fantastic job of finding this on realtor.com. So what we're breaking down here is from 2017 to 2023. You can see the days on market nationally are definitely up, and we see that same thing in Texas, right? From the previous 2 years, 2021, 2022, fantastic markets for real estate, unbelievable numbers. Days on market is higher. But if you look at every year prior to that, the days on market is still significantly lower than anything in 2017, 2018, 2019, or 2020. And these are national numbers, not even taking into effect how big of a deal it is to be in a state where there's such positive net migration and positive forecast for the economy. So that's a really cool chart.
Yeah, I love that.
Next slide.
So this is same source, realtor.com, median listing price. Now this is national. So the national median list price grew to $430 in April, up from $424 in March. But it's listing, but to your point earlier, if you look at the lines, literally it's just most recent, it works its way on down from there. It looks like the pink line is about to hit the yellow line, so I'm not sure if it's going to keep eclipsing. Plus, these are listing prices. I know we've looked at it in the past. I would really love to know how many offers come in at below or above list, because I know in 2022 the number of deals that would come in over list was really, really high. I think that's starting to come back down a little bit, but this is the same thing as what we were talking about the previous slide. It's just every year it's come up and up and up from there, and it's still there. Even with the downturn nationally, it's still right where it should be.
Yeah, I recently flipped a little $300,000 house. Couldn't resist it, picked it up. Don't everybody expect this? Picked it up for 77, put 40 in it, plus 10 expenses, holding costs and such. I had 8 offers within 48 hours, all at full price or above. Wow. So in the lower end, you're still seeing a lot of offers. I think as you get higher and higher, you're seeing fewer and fewer. But if you're in that market where you should be, if you're going to really, market to the masses are buying those $250,000 to $400,000 homes. I mean, you're getting a lot of traction, a lot of attention, and a lot of offers.
Yeah, that makes sense. A rehabbed home at 300, that's a rare find.
Yeah.
And I think to Steve's point earlier, it's very difficult whenever you acquire the land and build a new home to get a price anywhere close to 300, anywhere in the country, even in Texas, which is one of the more reasonably priced relative to income. We'll see that affordability index later on. You just can't hardly do that in a new construction environment. So whenever you are able to rehab a property and put it on the market and it's done well, it's very, very attractive to entry or maybe one level up buyers, because you just can't get that in the new construction market. It's going to be exponentially more expensive.
Agreed.
This next slide is really cool. This is where everyone is moving in America. And it's a heat map for one thing, but also shows some of the highest growth counties out there in the country. Of course, the major metros here are all pretty heavy blue, with Dallas really being even heavier blue. But then you look at the biggest growth migration per 1,000 residents, and you've got Texas all over the board here, 4 of the top 10, I guess. So one of the big reasons that we feel, a lot of the areas in which people might be investing that we work with, Stephen, that you work with, can feel more confident in where we're going is just net migrations, really impacting those supply and demand numbers. You guys see anything else jumping out on you on this report?
Well, what I'd like to say is, if you're in Texas and you don't recognize that if you're looking in Phoenix and you're looking in Florida and you're looking in North Carolina, you got a problem. And the problem is the grass is greener. The grass is not greener on the other side of the fence. Right here in Texas is where the opportunity is. You should be investing in Texas near where you're at, so you can have more control, more visual, more eyes on the property. There's just so much opportunity in your own backyard. It just shocks me when people go, well, I'm looking at property in Michigan, I'm looking at property in Florida. I'm like, what are you talking about?
Yes.
There's so much opportunity here. You do not need to go out of state.
Yeah, I completely agree. If you live in a city like Austin, it makes sense to go out of there if you want to find single family. Maybe go to the tertiary markets, but further out. If you're in a state like California or New York, where it's so expensive you can't cash flow on single family, I can understand people coming into Texas. But there's so many opportunities in Texas. Why would you need to go to Phoenix or Florida? Just the proximity problem doesn't make sense whenever you have so many opportunities here. It's funny.
Yeah. Oh, I better, for full disclosure, our commercial deals, now that's different. We are buying commercial in Arizona, Florida, Tennessee, North Carolina. But when it comes to single family, there's no need to buy something that you can't put your eyes on that's not near you.
Yeah.
Next slide.
Next slide.
So this is kind of a continuation of what we've been talking about. It's the cities with the largest numeric gains. And so it's 18 to 19, 20 to 21, and then 21 to 22. Phoenix was pretty hot for a while. There still is actually 1, 2, and 2. So the Phoenix area has consistently been adding tons of folks. If you look at the number, so Derek started the Texases, which I appreciate, makes it easy to visualize. And 18 to 19, there was only 4, but look at the last 2 years. 1, 2, 3, 4, 5, 6, 8 of the top 15 were in Texas, with San Antonio being first place from 20 to 21, and then 21 to 22, 6 of the top 15, with Fort Worth being 1, San Antonio being 3. San Antonio was actually 2, 1, and 3, so more of the same. Tons of people moving to Texas. Just about every migration has been south or west, not too far west, but south or west for the last handful of years, and I don't really think it's going to change anytime soon.
Yeah, it's also interesting, Phoenix. If I were to look outside of Texas, I love Arizona, and look at Phoenix, number 2.
Mm-hmm.
Number 2 is just a phenomenal place, even for commercial real estate. So that's the one thing outside of Texas that people should keep an eye on.
I would definitely say that. And then Charlotte, I hear a lot of positive things about that too. If you look at that, it's very high on the chart. It interestingly enough did not seem to be in the 20 to 21 numbers, but it was very high both 2018 to 2019 and 21 to 2022. But yeah, I don't hear as much about Charlotte. I hear a lot about Phoenix for sure. The net migration is very impressive there.
Yeah, it's shocking because I'm from North Carolina and Asheville, and that is one of the most beautiful states. It always shocks me that people aren't moving there just as much as they're moving to California. It's a different style, I get, but it's still got a natural beauty like California has their natural beauty. I would really think that North Carolina would boom sooner or later when the word gets out. And then while we're talking about out of state, I'm loving Florida too. One of my members has, I don't know, 20 or 30 short-term rentals near one of the beaches, and she is killing it. On it. It's just it's such a beautiful, the coastlines are so beautiful, and it's such a vacation, mentally, it's such a vacation spot because of Disney, because of Universal, SeaWorld. The short-term rentals in Texas, in Florida, they're killing it.
Yeah, I hear the same thing. And the net migration there, even beyond that, very high net migration too. We'll get to a couple of reports in a moment that while, and you see this here, you got a lot of Florida there, Jacksonville, Port St. Lucie, Cape Coral, you got 3 of the top 10. So that's pretty strong as well.
Oh, I didn't.
All right, let's go to this.
Yeah, I wasn't even looking at 21, 22. You're right. Holy Toledo. Yeah, they're coming up.
For sure. All right, the next slide. And this is a little bit of a summary of what we had before, but I thought this is a pretty interesting number. When you combine Dallas and Fort Worth, which were separated on that previous report, that is the largest growth year over year area of any major metro with 170,000 people year over year. And Houston is second nationally with 124,000. And Dallas moved up to the nation's 4th largest metro behind only New York, Los Angeles, and Chicago. So real interesting growth there. And then let's go to this next slide. I think we've been covering population growth a little bit, but Derek did a great job of finding this. I want to break down a little bit of what we're covering here. So this is a PwC and the Urban Land Institute, and they went and interviewed a lot of really smart people in the real estate space. And this is not exclusively single family, This is kind of like all real estate in general, and also economies in certain different areas. So you can see the people that they interviewed for this. A lot of them were private property owners or commercial multifamily real estate developers, real estate advisory service firms or asset managers, private equity, real estate investors, banks, lenders. So a really diverse group of people that should be experts in this particular space. They do this every year, and some of the information is really compelling. So if we go to the next slide, this is the poll of all these individuals rating on a 1 to 5, weak to strong. What are the best areas for real estate investor demand? And this was a little bit surprising to me, but if you think in the commercial multifamily space, with so many businesses moving to Austin, there's obviously been a correction in single family that was due because it was just so dang hot. But so many businesses moving there, still relative to other areas, very attractively priced. It's at a 4.62, crushing anybody else, honestly, which was a little bit surprising to me. Then you got Dallas at 4.4, San Antonio 3.73, Houston 3.61. Those major metros that we talk a lot in here about, all very, very strong. But anything else jumping out from you guys on this particular report?
No, not for me. It's just more of the same like we've been talking about. Texas is all in the green, right? Everything to the left. No, looks more like the same to me.
Yeah.
I'll tell you one thing. New Orleans being way down there at 2.33. I bet there's some good deals in New Orleans. If
It's
there's
funny,
nobody
we saw another report on like net migration in Louisiana is really not great too. That's my home state, so I hate to see that, but yeah, that's a rough number.
For that city to be so low.
No. Look, but you do see, while Phoenix is not, interestingly enough, Phoenix is not that high. It's not bad, but it's not as high as you might think. Next slide, we got local economy. Also, Austin at the top, Dallas second, San Antonio a good bit down from the other two, Houston even further down, but still all very, very highly ranked. But you do have, to Steve's point earlier, tremendous amount of, you got some North Carolina here, a lot of Florida, tremendous amount of Florida, all on the top there. Miami, West Palm Beach, Fort Lauderdale, Tampa, and then you got both Raleigh, Durham, and Charlotte in your home state of North Carolina that are doing strong. But so this is just not anything just particular about real estate, but if you have a strong local economy, you're going to have a strong area for real estate investment. Things should continually go up there. So these are very smart people. This is a prognostication for the next year coming out in April. So sometimes, you got to not only look at existing data, which what we've been covering thus far is where we are today. There's a lot of very smart people saying where we're going to be a year from now. So we thought this was good info to bring to the table. Anything else here in this group, Jeff or Steve?
The 4.6 Austin is what's driving, I'm sure, the 4.5, the previous ranking, right? The Austin economy, while the real estate slowed down a little bit as far as single family, like I said, the economy is really, really strong. A lot of companies moving into Austin or have already moved into Austin, and it's booming right now.
For sure.
Yeah, no comment from me.
So this next slide is real estate development, redevelopment opportunities. The numbers kind of move around a little bit. Dallas jumps to the top. Very interesting. Houston has been fourth on every one of these, which is also interesting. I assume that may have something to do with the fact that oil and gas is a big part of Houston, and maybe some people wanted to keep an eye on that. I'm not sure. But it is interesting that it's fourth in these rankings. Now, I do think this involves a lot of commercial multifamily. I think in the single family space, there's a lot of very positive dynamics in Houston. But I thought that was interesting that they're fourth in each area, but that Dallas jumps to the top over Austin in this particular group.
The only thing that jumps out at me is that last place, San Francisco. I mean, I listened to some stuff, and San Francisco commercial real estate is a disaster, right? And it's not going to get any better anytime soon, from what I understand. It's no bueno down there.
I heard 40% commercial vacancy in downtown San Francisco is what I heard on that on a recent podcast the other day. So I thought that was a frightening number.
Wow.
That's the same thing with increased interest rates, increased insurance. Like it's not good.
All right.
I'll cover this one. These are housing starts. This is housing starts per household. So it's relative to the population. But if you look at the charts, that red line going across a single family, and that's the average, right? That's the average over this 60-year span. And the green is multifamily. So that is the average down there, right below 5, 4.5. So the thing that just jumps out at me is if you look at basically since the financial crisis of 07, look at single family, we have not gotten up to average yet. Same thing with multifamily, honestly. Like the multifamily has been, I don't know what was going on in the 60s and 70s, they were going crazy, but they stopped. And then basically since 89, 90, I guess there's a few blips recently, they were above average, but there just has not been much housing being built on either side for the better part of 10, 20 years.
Yeah, I mean, I was listening to a podcast talking about this the other day. One big thing they did mention, of course, is new home construction, new home builders, developers. A lot of them were really burned in that period right there around 2007, right?
Yeah.
Spec home builders, developers got crushed. So they've all, I mean, that sting has not gone away because people are still cautious in that space, right? It's been 15 years now. But another thing that's interesting that I heard them talking about is just the amount of regulation, how much it has gone up, how much longer it takes to get permits, and just how much more expensive it is to build because of regulations. And a lot of those things did come in around the times whenever these numbers started to drop. Jeff, you mentioned the 80s, how it really dropped, and a lot of these regulations were put in that time. It's just something you have to navigate. Some of those things are really good. It makes higher quality homes, hopefully safer homes for people, et cetera. But there is an impact on cost. There's also an impact on just the number of homes being built. Any thoughts on this, Steve?
Yeah, it's tough to look at this quickly. I looked at this slide a little bit, didn't really realize exactly how impactful 2007, 8, 9, 10, just disastrous for single family starts. And the multifamily had a minor disaster by comparison. And in 2007, I had about 4,000 apartment units. I didn't see any negative cash flow. In fact, the rents went up. So it's interesting to see the starts dropped. I guess that's why my rents continued to go up.
Yep.
There's just less inventory.
No competition.
Yeah. I also think the cities are wiser now. If you go back to the 70s, I remember them talking about and reading articles. This was, I guess, really the 80s. This would have been around 87. And look at that peak, the one they got actually circled. You can tell that they had overbuilt, because look at the downturn right after that. But now it's almost pretty consistent, except for during the Great Recession. The cities have gotten wiser about not giving out too many permits and getting it overbuilt. So I actually like what I'm seeing. And I even like what's going on in single family. I do want to see it go up, of course, so it's good for everybody. But at least we're not seeing these crazy spikes anymore.
Yeah. Yeah, spikes lead to corrections, right? I mean, if there's more balance, that's one reason why I think Texas, like, you don't see these outrageous spikes that you have in the Californias or even Phoenix. I remember back during the great financial crisis, Phoenix was arguably one of the biggest booms in the entire country. Then they had a huge fall. You don't get other than Austin, you don't get that massive appreciation as often as you do in some other parts of the country. It's normally a little bit more steady, although Dallas has been pretty profound the last couple of years. I think this is one of the bigger spikes that we've had in Texas real estate history. hopefully that doesn't necessarily need to lead to a huge correction from here. I don't anticipate it does because the lack of supply, but it is interesting that you know, these big booms, the numbers, every time you got a really big number, it does seem to follow something a lot smaller whenever it's being overbuilt, to Steve's point earlier. And it normally does not stop at the average, right? Like it's not gonna just pause at the average. Like it's gonna be a big depression from there. That's a great chart. Thank you, Jeff. I think you found that on your Twitter feed. Is that right?
No, the couple over. I don't know who. I think Derek found it.
That may be Derek. That may be Derek.
The buying versus renting is the one I found scanning Twitter late at night. That's what I do in my spare time. Look at real estate stats. It's an exciting life.
So that other report kind of shows relative to population, but this one really is profound to me. We all know the population was drastically lower in the 60s, 70s, 80s, and still not building more homes than we were at that point, just straight up, right? Like that, I'm not even talking relative to population.
Yeah.
We're not building as many homes, period, as that were being built in the 60s. Definitely not in the 70s.
Yeah.
In the 80s.
If you go to the next slide, yeah, if you go to the very next slide, it shows exactly what we've been talking about.
Holy
There it
Toledo.
is.
Wham.
So there's a population going that way, and then the starts are just plummeting.
This is a little bit more recent, right? This is 94 to current.
Yeah.
You go to the previous slide, it goes all the way back to the 60s, right? That's a long time ago. Population was half back in the 60s.
Wow, that. You can just see overbuild, crash, overbuild, crash, overbuild, crash. And then the government started stepping in looks like around 83 or 84, and you start to see more consistency. Even though it's down, it's not a straight down.
Yeah, I mean, you're not going to see the spikes with all the with so many places being regulated. You're not going to see the spikes anymore.
Yeah.
So we are getting a little close on time. So this rental vacancy, I think that's very critical. You know, Steve was talking about this earlier. You look at rental vacancy rates, very low compared to the last several decades. It's going up from where it was not too long ago. It's going up a little bit, but these are very attractive numbers if you're a real estate investor in the residential space, that the vacancies are very low historically. The only other time that they were lower, was in another time of extremely high interest rates from the 70s to the mid 80s there, extremely high interest rates, which means a lot of demand for rental property. So I think as long as rates are projected to stay high, vacancies are going to be lower, which is good for real estate investors. And the great news is, if rates start to come down, you get to refi and get more cash flow, even if you don't have the continued increase in rates. So that's why real estate really works well. You win if you win if it goes up, and you win if it doesn't go up on the interest rates, right?
Yeah. If you go to the next slide, I think it'll show what we're talking about with the rate. So this is a slide that I was talking about. So mortgage rates are back up at 7%. This compares dollars spent. The yellow line is the average mortgage payment. The blue line is the average rent payment. And so historically, the yellow line has been higher than the blue line for the most part. But look at what's going on today. Look at that literal vertical climb on the yellow line relative to the blue line. So that's why I don't think you're going to see the vacancies anytime soon. You're going to have you'll have a lot of eager renters, Steve. That's why it takes you like 3 days to rent a property as opposed to 3 weeks. I mean, look at that. That is a massive spike. So I'll just read the graph. It says the cost to buy a house in America is now approaching $2,700 a month when you factor in PITI. Cost of rent is $1,850. That is the biggest gap it says we've seen. I mean, I imagine that's the largest gap in history in the United States of rental versus a mortgage payment. So,
wow, no wonder.
What does that tell you?
Renting. I mean, we're filling up these new construction apartments rapidly. No wonder. People are going, let's go buy a house, honey. Wait a second, $2,700 a month. That's half our pay. We can't do that. We're not going to qualify, and two, we don't want to do that. and they're going to these beautiful apartments.
Wow.
Yeah.
That's an amazing chart.
So,
This is the one you found on your Twitter feed, right, Jeff?
yes, this was the one I found last night. I mean, they'll eventually meet again, but it's going to take a while, and someone's going to have to give one way or the other for that yellow line and blue line to meet again.
Yeah. But you know, if you are a landlord of either apartments or single family, you have a lot of upside on your rents because people make a comparison. They're making a decision, right? I want to own a home, but I don't want to get crushed in order to do it.
Yeah.
And right now, they're kind of getting crushed in order to do it. So your rental opportunities are very attractive relative to the alternative, and that's a very good indicator for landlords.
Yeah.
Interest rate predictions, I'm going to cover this briefly. You know, oftentimes in the past, we've had multiple prognosticators, but I thought this breakdown was good and that it just explains what will impact things. So scenario one, inflation remains high. Fed is forced to raise rates repeatedly. That means rates could go as high as 8.5. That would be a challenge, but I think it's a possibility. Scenario two, CPI responds more to the Fed's rate hikes. There's a gradual deceleration of inflation, causing mortgage rates to stabilize near 7 or 7.5. That's about where we are right now. We had a pretty big rate increase in the last couple of weeks, honestly. So, and we saw a little bit of decrease in like traditional owner-occupant applications. So that is something to keep an eye on. Then scenario three, Fed raises rates repeatedly to curb inflation, and the economy falls into recession. This could cause rates to drop. Likely drop to 5%. That'd be a boost for the housing market, but it would also be bad because there'd be maybe in a deep recession or at least a reasonable recession. So that's a breakdown on what the possibilities could be. I have seen a lot of prognosticators. A lot of them are still kind of splitting the road, saying that rates are probably not going to come down significantly through the remainder of the year, and that they may start to come down early 2024, maybe late this year, possibly. But I think we're going to have to weather the storm of rates, at least for the foreseeable future.
Yeah, I agree with that. That I don't think anything's going to drop till early 2024 or mid 2024.
Yeah.
Unless, like, you know, but again, we're crystal balling it. Something could change this year, and the Fed go, hey, let's go ahead and lower it. But I think it's going to take another 6 months, and then those rates will come down in 2024.
Yes. Next, today's rate 6.96. Rates have gone up quite a bit. That's on average for owner occupant, not for non-owner occupant. Non-owners normally a reasonable spread to that. Just making sure we're on the same page. I think we got a few questions, so let's just dive into the affordability index. I'll try and go through this quickly. A couple interesting stats here. Number one, you can see the progression, right? We have that pre-COVID number a year ago and today. Houston is maybe the most compelling story. If you look, Houston was the 26th least affordable major metro. This is kind of like an actually lack of affordability index, not an affordability index. Houston was up at 26. Then it went to 27. And then in the last year, down to 43. That's a pretty compelling story. Austin was at 28, 21, and then 20. Dallas, 20, 30, 25. And then San Antonio, still incredibly attractive for all the amenities there. 51, 51, and then down to 62 and affordability. But definitely Texas very compelling and attractive relative to other major cities with comparable amenities. You know, still good reasons to move here for people in all the different ways we said.
Yeah.
Yeah. I want to know what the heck's going on in Detroit. Look at that price, that home price. Average home price, 80 grand.
Wow.
That's insane.
Look at, you know, just a funny anecdote before we wrap up. Newark, the average household income 40,000, but the home price is 385. You go to, I was looking at Detroit. I said, well, it's because the household income's 35, but then the average house is 80. That's a very big difference. Like Newark, wow, that's brutal.
I gotta believe people are driving into Newark. I don't know. That's crazy. Like I don't know how anybody making 40 grand, unless you just handed out government subsidies like left and right. I don't know how anyone can afford that payment on 40 grand.
I don't think that's going to happen. Yeah.
Yeah, the one
All right.
positive though is Detroit has no place to go but up.
True that.
They could turn, the right leadership could take an opportunity like Detroit and turn it around.
Yeah. And that home price is significantly lower than anywhere else for sure.
Amazing.
Yep. All right, Derek.
Well, I'm back to let everybody know that we do have a winner of today's drawing. So each month on our real estate market update, there is one lucky winner. You have to be live to win. And the person that wins today's half off your next hard money processing fee is Brian Gleason. Congratulations, Brian.
Woo, good job, Brian.
Brian.
Hey, can we do the next slide? So just to show Steve's, for somebody want to reach out to Steve's organization, they know how to do so, because I think it's on there. There we go.
Absolutely. We're glad to have Steve with us today from Total Wealth Academy. Like we mentioned at the beginning, there is going to be a VIP real estate networking mixer in the Dallas area. We'll actually be at Bar Louie in Irving, Las Colinas, near the Toyota Music Factory on June 7th, that evening from 6 to 9 p.m. A lot of VIPs, a lot of real estate investors looking to network and grow their team that's going to lead to their success. And people that have joined our webinar today are looking to do just that, and a few of them have questions. So I want to bring a couple of questions that we've had. One question is, what is the best way to position myself financially and a lending approach to grow my investment portfolio from 3 to 5 to 10 single family properties over the next few years?
I'll let Steve take a run at that first. They mentor single family investors all the time.
Do me a favor, read the first two sentences again.
Absolutely. What is the best way to position myself financially to grow my investment portfolio from 3 to 5 to 10 single family properties owned?
You know, this could be just a money question. You want to be saving as much of your earned income as you possibly can, not in an IRA, not in a 401k, your own money, save it. And the best position is going to be subject to the type of financing that you get, which is why I love Wade and Jeff. They've got the best financing, the hard money loan, the bridge loans, where they give you the money to purchase the property and rehab it all in one loan. That's going to help you leverage your money to the highest and best use. Because if you use a regular loan, the down payment or total out of pocket is usually 3 or 4 times as much as what you would put down on a deal using Wade and Jeff. So the best position you can put yourself in, save every dime you got that you can without destroying your lifestyle. Get approved, use leverage, and buy them as quickly as you can. It's just, to me, that's a tough question to answer without knowing how much he's got in savings right now.
Yeah, I was going to suggest we talk about this in our meetings because we want our customers to be able to buy as many properties as they can, because the power of investing over time, it's very powerful, right? So we talk about, regardless of the interest rates, I know they're higher now than they were in the past. If we talk about pulling cash out, maybe they don't have a lot of money saved up, but they have a property that's got some equity. The values have gone up, everyone saw that. So if you've had a property for the last couple of years, you have equity in there, you can tap into it. And even if your payment's going up on your own your you use that money to buy 3, 4, 5 rental properties. That cash flow pays for the increase, and now you're sitting on 5 rental properties that are appreciating at 4 or 5% every single year. So if you don't have a lot of cash, because it does take some money to buy these properties, but you have a property that you already own, talk to one of our people. We have a great tool we can show you that displays how much more wealthy you'll be in, say, 5-10 years down the road if you pull money out of your refi and deploy it to buy more properties. Like, it's ridiculous.
Yeah, the people need to understand that if they've got a lot of equity in their deal, they may be going, hey, I put 20,000 down, I'm making 500 a month, 6,000 a year, that's a 30% rate of return. No. What if you've got another 100,000 in equity? That's actually 120 you have to compare it to. 6,000 divided by 120, that's going to be about a 5% rate of return, not a 30% rate of return. So they've got to consider that what would be called dead equity, it's not serving your family properly. Dead equity, get that out, go see Jeff or Wade and get that money out and get it working in more property.
Yeah.
The good news is you probably answered question 2 with that answer for question 1. The person was asking that a friend of mine recently explained how they paid cash for 3 investment properties and that he would do it differently next time. I've been reading about leverage, it says.
Yeah. Paying cash for real estate, bad idea. That is dead equity. Dead equity.
Yep. The wealthiest real estate investors on earth, the big players, they still all use leverage, and they could do tons of deals for cash, right? But everybody uses leverage because it just boosts your ROI to unbelievable levels. So if you have enough money to do, buy an enormous amount of single family properties for cash, you should probably, maybe you want to buy a bunch of single families, use leverage, and then take some of that extra money and go work with Steve on something else. Maybe we'll do some multifamilies together or something. Like, you should not just say, I've got $1 million, I'm just going to buy 4 houses for cash. That's not a great move.
Yeah, that's a bad idea.
Yep. All right. Well, in wrapping up, I do want to ask one other question real quick. Steve, I see that we have your information here, but what are the best ways for people to reach out to your team?
So the best way is to go to totalwealthacademy.com. What we do is we offer a free sample class where people can get a taste of our teaching method, our teaching style. They can, if they're in Houston, they can see it live. If they're outside of Houston, they can watch it online. But there is one thing I'd like to share with everybody watching this, please. Be aware, everything that we saw is current data. And a lot of people will try to predict the future based off of current data and historical data. You've got to remember, that's all crystal ball crap. Here's 2 things I can guarantee you. These are 2 predictions that I guarantee are true. Next year, a bunch of crap we didn't expect is going to happen. There's my guarantee. My second guarantee is you're going to have to improvise, adapt, and overcome to whatever the hell happens. Believe in yourself. The market doesn't make or destroy you. Just adapt to the marketplace, adapt, overcome. I mean, you can do it. Don't sit there behind predictions and go, well, I think this is going to happen, so I'm going to curl up in a ball over here and not buy any real estate. Don't do that. You should be buying in the up market, the down market, if you know what you're doing. If you have educated yourself, you know how to make money in both the up and down markets. You really don't care what the market's going to do, but you do want to watch things like this so you know exactly where the market is and which strategy you should be using.
Those are great points, Steve. My last point to just add to that, in a high inflation market, sitting on the sidelines means that you're just losing purchasing power, right? So you need to do something to withstand that. It doesn't have to be guaranteed, it doesn't have to be fantastic, but you want to maintain your purchasing power. And real estate investing in general, historically, whenever in times of high inflation, real estate always does really well. It's one of the asset classes that do really well, even in inflationary moments. If you're making intelligent decisions, you're doing like Steve said, and hustling and finding those deals, those deals that may not be easy to find in this market, but they're definitely there. All right. Thank you very much, everybody. Steve, as always,
Thank
Excellent.
you. That was fun.
Great insights. Yeah, it was a lot of fun, and we look forward to seeing you and your crew up in Dallas at that event. And you have another big event coming up. Tell everybody about that, just to put it on the radar. You have a like quarterly event, right?
Yeah, well, actually, let me talk to the people in the greater Houston area.
Yep.
The greater Houston area, we have a spotlight night coming up next Thursday, June 1st.
Mhm.
This is when about 200 or 300 members get together and we celebrate current deals. We do case studies of single family, apartments, self-storage, senior living. And by the way, I got to brag, our last senior living deal, the cash on cash, not the internal rate of return, just the cash on cash, 24% rate of return. The internal rate of return is going to be somewhere around 35%. So
Wow.
I would invite anybody in the greater Houston area, come check us out. Just go to totalwealthacademy.com/spotlight. It's called the Spotlight Night. totalwealthacademy.com/spotlight, and you can reserve a seat. We do serve cocktails, we have snacks, and we have a lot of fun.
Absolutely. That sounds great. Thanks again, Steve, Jeff, Derek.
Thank you.
Excellent work. You guys have a great day. Thanks, everybody.
Thanks, Steve.